Morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, the senior market specialist at FXCM, and my email address rshaw@fxcm.com. I just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments, and keep this on screen for a few moments. All right, thank you very much, Anna. Hey, Indran. Morning to you. Morning, Anna. Morning, everyone. Thank you very much for joining. All right, let's just bring up the market commentary disclaimer. Just our references, MarketScope 2.0, tradingview.com. What I want to actually start with is, we'll go through to TradingView. I actually want to start with MarketScope this morning. So this is the NASDAQ, and NASDAQ's featured quite heavily in our analysis for 2023. And the reason that it's featured heavily in our analysis is because it's really performed remarkably well. And what we want to do here is just carry on with the analysis, see is it still going to be performing remarkably well? And of course, the answer to that is I don't know, but what I can tell you is that the momentum is starting to wane. So when we are in what we call the upper quintile, when we're above 80, that's when there is exceptionally strong momentum. That's the way the stochastic formula works. I've read in textbooks about overbought, oversold signals on stochastic, and whoever wrote those doesn't understand the formula behind the stochastic. There's no such thing as overbought, oversold on stochastic. There is on RSI, but not on stochastic. The so-called overbought signals are actually the upper quintile and the lower quintile. They are extremely powerful momentum signals. So you can see that the idea here is we've got a very strong swing, just as the momentum is in that upper quintile. And now there is a wane. Okay, there's a wane in that momentum, and it's actually challenging the zones. It looks like it might be falling out of zone 1, falling into zone 2. So whilst it's been quite a prominent feature in our analysis, and I think something that we carry on analyzing, because I think the sensitivity to interest rates are very much something that we can exploit. If anyone has been trading this, it's worth just noting that the momentum is starting to come down. This is on the daily scale. Now, the next part of the analysis I want to bring up is going to be the trading view. What I see here is the real rate. Again, it's a very prominent feature of our analysis because the real rate is what's driving market, and the rate-sensitive instruments such as the NASDAQ are either beneficiaries of that or the first to be penalized, depending which way the real rate goes. And it's now moved into a range. When I say range, it's gone neutral. It's gone into the neutral area between the two blues, and there's a squeeze here. Now, interesting, the squeeze, it's coming ahead of the CPI data. When's the CPI data due for release? It's due for release on the 14th, so that's going to be next week, Tuesday. So what's going to happen here is I expect some sort of potential expansion based on whether there is an upside print or a downside print. So the idea here is the inflation data is going to in our real rate our real rate's going to reflect in our rate sensitive instruments. NASDAQ is one, the dollar is one as well. What is of particular interest to me is the fact of what the media reports on when we start losing the momentum. So there's going to be bullish reporting over here, and there's going to be bearish reporting over here. And it's quite interesting just to see the, it's very interesting to see the topics that the media talks about. So one of the topics that has come up is that the terminal rate, so a market strategist in the US has suggested that the terminal rate has to be 8%. It's not the only person that has come up with an 8% call for the terminal rate. I have actually heard it somewhere else. That to me is very high. You know, never say never. Strange things happen. So potentially we get a terminal rate of 8%. I don't see that happening personally. I'm going to show you my reasoning behind that, and I'll tag on subject to correction, but I think 8% is nothing short of damaging, and that really forces a hard landing. So the idea behind that is more needs to be done to control inflation. And the obvious question is, well, why? You know, so what we're going to do is let's bring up the core inflation rate here. Excuse me, I've got the sniffles. I felt it a couple of days ago. I told you it's now set in. All right. Yeah, let's go through to the United States core inflation rate. Okay, and let's take out the zones. Well, let's look at it in terms of the zones, and then we're going to take out the zones. So it's fallen from its, let's call it the bullish area for want of a better description. In other words, the bullish area. Anyway, it's the positive area. It's the area that really suggested that inflation was not transitory. We've moved now from the strong bullish area into the neutral area. Okay, now what we can do is let's get rid of the Bollinger Bands. Let's add in our peaks and troughs. Okay. It's not core PCE. Let's make this core PCE. Sorry, this is the CPI. Let's make it core PCE. The reason that I'm putting in core PCE is because that's really what decisions are going to be made. That's how decisions are going to be made. Oh, no, that's not the right one. Beg your pardon. This is the one I want. Yeah, that's better. Okay, let's put in our peaks and troughs here. Okay, so they're already there. Peak, trough, lower peak, lower trough. Now, effectively, the target for the Fed is an average rate of 2%. So we write that here. All right, so we've got this 2%. Now, we can see that inflation started moderating, and it started moderating at a inflation rate. Let me just see. We've got a Fed funds rate now between 450 and 475. It's going to go through to 475 to 5 on the 22nd of March. So, and the terminal rate at the moment is priced at 5.25. Now, all of a sudden, there are strategists that are coming through and they're saying, well, we're going to see it go to 8%. But you can see that the core PCE has started already moderating. What the strategists that are calling for 8%, they say, well, we've done everything we can at at the current levels, at the 4.5 to 475 level. Even if we go up to as far as 525, they're suggesting we're not going to reach that 2%. That in my estimates a big call, and the way that we can test that is we're going to throw in the acceleration, the rate of change of the rate of change. So we looked at this in our 2023 outlook. So let's just set in, and I'm going to try and sort of explain the way I see it, and hopefully I do the explanation justice. But the idea here is we think about it in terms of a car. Let's say you guys get behind the wheel of a car, and you start driving, and you get the car up to about 100 kilometers per hour, 120 kilometers per hour. To get from 0 to 100 or 0 to 120, you've got to accelerate, okay? And that acceleration increases. The faster that acceleration increases, the quicker you're going to get to 100, or the quicker you're going to get to 120. What happens is that's acceleration. That's what we call acceleration. Acceleration to get to that 100, that 120, which is effectively the rate of change. So the idea here is, once you get to that 120, that 100, 120, and let's just say you want to cruise at that speed, you stop accelerating. You stop accelerating. In other words, your acceleration then starts moving towards 0, and then you just you're holding your rate of change on at 100, at 120. You're not changing it. If you want to go from 100 back down to 0, you want to stop, then we've got to do what's called a deceleration. We've got to stop, but we've already started decelerating on core PCE. It's under 0, okay? As long as we stay under 0, okay, as long as we stay under 0, can you guys see that it's under 0? It's at minus 12.77. As long as we stay under 0, we decelerating. We're going towards that 2%. Okay, and now you want to. So we're effectively doing the job at in the range between 450, 475. 22nd of March, we're going to the range 475.5. Thereafter, I'm not sure when the next one is. I think it's July. It's going to 525. You go through to 8. Okay, you're gonna crash the economy. Okay, it doesn't make sense to me. Now, where potentially it can make sense, now this is where it gets a little bit tricky, okay, is when we bring up the median CPI. So we're looking at a slightly different way of looking at inflation, right? I really like looking at inflation on a median level. Yeah, it's not the right one, is it's not the right one, I beg your pardon. I've done that twice now. I think this head cold's getting to me. Median inflation. Yeah, this is it. United States CPI median year on year. That's the one. That's the one. Okay. So you can see that the median inflation is showing signs of moderation. Now, what's the big deal about median inflation? Median inflation is slap bang in the middle of your inflation basket. It represents the sticky stuff. It doesn't move until it won't move until the low-hanging fruits started reacting. What the Fed has been worried about is that it was only the low-hanging fruit that was reacting, but now we can actually see that the median, right in the middle, starting to moderate as well. Now, what we have is the acceleration of the median. That's still got to get down to 0 and below, but it's getting there at quite a pace. It's getting there really quickly, okay? So what happens is the terminal rate should perhaps be moved up if this tapers off, If this tapers, let's change the color of this one. If your acceleration tapers off, in other words, you're still going from 0 to 100, okay, you still need to decelerate, and you are at 5 to 525, okay, then perhaps we can talk about hiring the terminal rate. Talking about hiring the terminal rate now is nothing but premature. It can't be anything but premature because we're heading towards that deceleration, and that deceleration is exactly where we want to go. So again, it's just very interesting to see what's been reported in the media as soon as the momentum starts coming out of the risk market. The risk market should actually be pulling back at the moment because we've had a terrific run. We've had an absolute terrific run here. Point that we're getting complacent in the market. I'm certainly guilty of being complacent because this has been such a cool swing to be a part of, right? So how do we measure? How do we measure if pullbacks are due? Very easy. We go to the VIX. Okay, so we go to the VIX, which is the Chicago Board Options Exchange. So let's just bring in the VIX. It's what we call the fear index. This is as far as we're going to go today, by the way. So just stick with me because it's really important. And what the VIX is, it's a measure of expected volatility over the next 30 days based on options of the S&P 500. Okay, based on options for the S&P 500. And what we'll do is we'll go through to the weekly. Let's throw in our zones. Okay, so the zones are Bollinger Bands. And the first Bollinger Band is 20 and 75 standard deviations. Take out the basis. Okay, we don't need the middle. And the second one is just normal. Let's take this out. We'll make this red. All right. And what you can see is you are in this region. We call it the complacency region. It doesn't necessarily mean that there's going to be a. It doesn't necessarily mean there's going to be a pullback, but it does suggest that, according to options pricing, more people are long call options. It means they expect prices to carry on moving up. And then what tends to happen is when people have a huge put position, they are probably too bearish there. So these are the two sort of extreme regions. I understand that explanation was a little iffy, so if you have problems with that, just type that through and I'll try and make it a little bit clearer. But I want to show you visually where it's quite easy, dare I say easy, to make an analysis on the VIX. So the way that we're going to do that is we're going to bring in an RSI underneath. Okay. My system's a little slow this morning. I'm begging your pardon. Here's the RSI. Now, what I want to do is I want to add a signal line to this RSI. So what you do is just add the indicator. I'm just going to add an exponential moving average. We're just going to use a 3 period. Okay. It's not the moving average not meaningful except it serves as a signal line. And what I want to show you is we're getting a signal here. We get crossover. Okay, we're getting a crossover whilst we're in the complacency region. Okay, what does that mean? All right. So far this is all pretty confusing. Well, to make it a little clearer, we're going to add the S&P 500. It's most meaningful to add the S&P 500 because these are options based on the S&P 500. So let's just add that in. And what I want you guys to take a look at is the crossovers. Let's use a vertical here. So here's a crossover, and here's a crossover, and lo and behold, here's a crossover, and here's actually a crossover we can use as well. And what happens is when we are in these complacency regions, it's probably been a very long bullish run. The markets are quite proud of themselves that they've been. This over here is not in the complacency region, and the reason is not because there's no bullish run here. But here's a long bullish run, here's a long bullish run, here's a long bullish run. It puts us all into the complacency regions. But when we get the crossover of the RSI, when the RSI crosses over its signal line, well, take a look what happens to the S&P. Okay. Get these pullbacks. So now what I'm suggesting is we've got the crossover. I wouldn't be surprised to see some sort of pullback here. Wouldn't be surprised to see some sort of, but that pullback will be taking place in a market that is potentially bullish. Okay, I did say the VIX was the last we're going to go. Let's just round it off with a analysis of the SP 500 weekly. Where now watch this very carefully. This is really what we've got a here's a peak, higher trough, higher peak. You've got a trend on the S&P 500. You've got a signal that we're starting to pull back potentially on the VIX. Well, okay, that actually excites me because it means that we probably get the next higher peak, and we probably get the next higher peak, and we can try and exploit. So the idea here is just be very careful what you take in from the media. 8% terminal rate, well, I certainly wouldn't say it's impossible. It's not the right time to be calling for an 8% rate based on the acceleration. What's the stochastic settings? The stochastic settings are the same on all the charts on the main layout, 1555. We actually just need the %K there. Okay. Does that? Did you get that, Indran? Okay, cool. Alrighty, that's as far as we're going to go this morning. I think we've done quite a sort of a complex type of analysis. If there's any confusion, please email me. I'll try and make it a bit clearer. rshore@fxcm.com. I want to wish you guys a great day ahead, a great weekend ahead, and we'll chat on Monday. Thank you very much for joining this morning. Very much appreciated. Cheers, guys.